When XRP suddenly vanishes from exchanges, it will be hard for most people to notice. No, this is not an assumption. The current configuration is identical to those that have previously sparked off explosive supply shocks. Such occurrences cause prices to plummet in ways that the average retail investor could never have imagined, rather than merely fluctuating by a few percent. Actually, the coming months are going to be absolutely unprecedented in crypto history. How you position yourself now will determine if you're one of those who look back and wish they had acted sooner, or if you were prepared and grabbed life-changing opportunities when the blow came. Your money is not being advised by this. There is substance to what I'm going to demonstrate. Supporting this theory are past price movements, volume triggers, and liquidity conditions that have previously caused XRP to burst. Also, if you're looking for a comprehensive strategy that's easy to follow along with, I've laid it all out for you in the XRP Millionaire Blueprint. It includes documents, infographics, and videos. Below this video, in the pinned comment, you'll find the link. This blueprint will show you the fastest method to position yourself like the smart money and understand exactly how to prepare for what's coming. Allow me to explain why XRP is about to experience one of its most significant price movements ever, and why, once the volume rush begins, exchanges may run out of tokens quickly. Examining liquidity flows will shed light on the underlying mechanics. Investments in hardware and software are soaring at the moment. This isn't coincidental. It shows exactly where fresh money is going in the U.S. economy. Now we get to the important portion. The current situation is eerily similar to the beginning of the dot-com bubble in 1999. During that time, companies' investments in new technologies skyrocketed, leading to markets experiencing unprecedented growth. Unfortunately, due to a lack of knowledge about when to invest, 80% of investors lost all of their money when the bubble burst due to its overextension. This same growth trajectory is seen now, but it is strongly associated with the adoption of blockchain technology, tokenization, and institutional integration, rather than the other way around. This new capital cycle has crypto as its focal point rather than as a side play as it once was. Due to its unique status as a token that is integrated with financial rails, liquidity corridors, and ISO standardized systems, XRP is in an ideal position. Here's where the majority of individuals go wrong. The rise in cryptocurrency prices, they think, is all in good faith. However, when liquidity comes in at a faster rate than exchanges can handle, supply shocks occur, and the price of XRP goes up. This very situation has transpired previously. An extreme shock of 51 billion in 24-hour trading volume occurred for XRP in November. A record-breaking surge in demand caused XRP's price to skyrocket from 0.47 to 3.45 in a matter of seconds. There was substance to that bluster. All it came down to was the laws of supply and demand. There was an excess of buyers and an inadequate supply of tokens, forcing prices to spike sharply. Now we can make the connection to the present day. With a market worth at around $166 billion, XRP is now trading at 2.78. $10 to $15 billion in daily volume would be required for a minor supply shock. That alone could cause a 10% to 20% increase in price. It would take $15 to $25 billion, or 20% to 50% of the market cap, to produce a noticeable shock. We would want $25 to $50 billion in daily volume for a significant shock, though, the kind that rewrites the entire chart and makes news globally. That's the threshold where XRP has exploded in price, increasing by multiples in a matter of days. The truly intriguing part begins now. All the pieces that came together to cause that shock in November are falling into place again, and this time they have more ammunition on hand. Rate reduction and regulatory guesswork were all that was going on back then. New money is flooding the markets today as a result of the rate reduction. As a result, assets like XRP are subject to increased capital chasing risk. The record-breaking investment in blockchain infrastructure by tech companies is strengthening the bonds between conventional tech and cryptocurrency. Scalable institutional uptake, including RWA tokenization by industry heavyweights like BlackRock and Vanish, as well as ETFs and significant treasuries. If these were all independent considerations, they would all be major issues. When combined, they have the potential to cause a domino effect of demand that would be impossible to resist. This time around, it's not only retail FOMO like in November. Institutional and banking institutions are adopting the method. Price doesn't merely crawl up, it jumps higher violently when exchanges run out of accessible supplies. Now for the exciting part, this is not going to happen in the far future. At this very moment, as we near the year's end, the liquidity setup, the rate cycle, and the institutional ramps are all coming together. For this reason, I think the price of XRP might rise into the double digits, maybe even above $10 per coin, if daily XRP volumes were to exceed $50 billion. And that is not conjecture. According to Grok's own models, there is no restriction on price when systemic acceptance meets limited supply. Current efforts are laying the groundwork for XRP to fulfill its intended purpose, bridging global liquidity through ISO integration, banking rails, and direct settlement use cases. For that reason, getting into the right position prior to the supply shock is essential. While people who grasped the concepts were hoarding coins earlier, you can buy them later for $8, $10, or $12 each. Those who are hesitant are consistently punished by the market. With a daily volume of just a few billion, XRP surged from 0.23 to 336 in 2017. Give that some thought. A 14x motion might be powered by as little as a few billion. The math is obvious when you scale it up to $50 billion or more. Furthermore, this is merely the initial phase, for the simple reason that institutional chasing, retail panic buying, media attention, and the initial surge of liquidity all work together to make the move even more dramatic. When it happens, the true parabolic phase starts. When you know how these supply shocks function, you'll start to appreciate why they're much missed. They anticipate a slow and steady rise in prices, but that's not how markets work. When demand meets illiquidity, they move in abrupt, explosive bursts. More so than nearly any other cryptocurrency, XRP is engineered to amplify such shocks. Because XRP has a finite quantity, and a significant chunk is held in escrow, unlike Ethereum and Bitcoin, which both have a constant supply that is added to the market by miners and stakers. This means that exchanges may run out of tokens to sell when volume increases, forcing prices to rise to meet demand. The reason for this is that past events tend to mirror present outcomes. If you review every significant XRP run from 2017 to 2021, including the surge in November that we covered before, you will observe the identical pattern. Issues with liquidity, unexpected spike in volume, and exponential refinancing. It's built into the asset, not something that happens by chance. Moreover, the current market structure is forming in nearly the same manner as those prior explosive surges. What distinguishes this cycle from others, though, is the magnitude of acceptance. Speculation about bank collaborations was the most talked about aspect of XRP in 2017. Matters of regulatory clarification were the focus in 2021. Now it's fully integrated into the foundation of the world's financial system. Beyond partnerships, we now have real-world settlement layers, messaging systems defined by ISO, tokenized assets valued in the trillions, and exchange-traded funds, ETFs, offering regulated entry points for institutional capital. The multiplier impact is that layer of institutions. Pricing can be driven up by multiples when it comes to retail alone. The possibilities, however, multiply exponentially when we include organizations capable of bringing in a single wave of tens of billions of dollars. This is why experts continue to say that prices in the double digits are within reach for the time being. Reason being, modeling liquidity movements makes perfect mathematical sense, not due to crazy guesswork. Let's have a look at an easy example. Picture a $166 billion market valuation for XRP at 2.78. Just picture a 2 or 3 day stretch of $30 billion in daily volume. Exchanges begin to reprice offers at levels much above the spot level due to the severe supply crunch that this causes. Price doubling or tripling in a very short time frame is possible when traders rush for higher prices, algorithms activate, and institutions intervene. You may skip years of waiting and obtain XRP for $8, $10, or $12 by following this identical method. Shocking liquidity storms, not slow adoption, are the problem. Here is the reality, though. Unpleasant news for the majority of regular investors. As usual, 90% of them will fail to notice it. A staggering 95% of crypto investors ended up losing money during the latest bull run. Just how? Reason being, during times of volatility, they either sold too soon, bought too late, or panicked. That's the result of being mechanically confused. It is strange when there is a sudden drop in supplies. The public assumes that prices will inevitably fall after seeing them trip in a week. On the other hand, XRP supply shocks don't simply retrace right away. In order to create the next step up, they frequently consolidate at higher levels, ensnaring those who sold. Transfers of wealth in these markets occur in that way. It is also important to note the direct relationship between this and macroeconomic situations. Interest rate cuts, for instance, are relevant beyond the financial markets. These are the fuel that cryptocurrency rockets on. The system will have more liquidity if interest rates are lower. Cryptocurrency and other risky investments attract liquidity-seeking yield that, along with record-high investments in blockchain and digital infrastructure by corporations, creates a positive feedback loop. Higher valuations bring in more investment, which in turn fosters deeper adoption, all because of the positive feedback loop of increasing liquidity. Because of its practicality in facilitating the efficient transfer of funds across international borders, XRP occupies a prime position within that cycle. Another crucial layer is institutional interest. Unlike other products, ETFs have a purpose. Super funds, pension funds, and other large investment firms can use these regulated on-ramps to pour money into cryptocurrency markets. When these flows start, they don't dribble, they pour in. And when all that money is going into a fixed supply asset like XRP, you get a full repricing of its value, not simply a price increase. Step back for a moment and examine the ever-present psychological loop. It all starts with skepticism. As XRP continues its sideways trend, investors grow disinterested and focus moves on to other things. The initial jolt of volume follows. The news starts to circulate when the price increases by 2 or 3 times, even if most retail investors still keep their money in the bank because they think it's too late. Early believers feel validated at that point. After the second shock, institutions begin to take action, the media becomes obsessed, and the fear of missing out, FOMO, skyrockets. The most advantageous times have passed by the time retail eventually gets on board in a large way. At this very moment, we are in the period of disbelief. Since there have been no major price fluctuations, people are putting too little stock in what is likely to happen. However, behind the scenes, there is harmony among adoption indicators, institutional infrastructure, and liquidity conditions. That's why most people will be taken completely by surprise by the shock. And the change won't be subtle when it happens. An explosive event awaits. The dynamics of supply on exchanges are another topic we should cover. Only a small portion of the total supply of XRP is available on liquid exchanges and circulates. The actual float that may be traded day to day is incredibly narrow compared to prospective demand, as a significant portion is locked in escrow or retained by long-term holders. For this reason, even small increases in daily volume can cause enormous price differences. Transferring XRP only requires tens of billions of dollars in short spurts, not trillions. That is just a small portion of the total dry powder assets controlled by institutions. Then, pardon the metaphor, there's the domino effect. When XRP makes a move, it attracts buyers and sellers from all around the cryptocurrency market, increasing liquidity. Traders get out of assets that move slowly and into assets that move quickly. When algorithms identify volatility, they use leverage to magnify it. This is how moves that last a day can become into parabolic runs that last a week. It's the liquidity network effect. Additionally, XRP has repeatedly proven that it is among the most powerful catalysts in the whole space when volume is high. Seasonality in the past is one of the most disregarded indications here. Crypto doesn't fluctuate haphazardly throughout the year. Liquidity typically peaks at certain recurrent periods. Once upon a time, in the late fourth quarter or early first quarter, there was a window like that. The time of the November shock, 2017 and 2021, were identical. With the same rate cycle, identical liquidity inflows, and an even larger institutional footprint, we are currently nearing that precise seasonal opportunity again. It's a deliberate arrangement, not a coincidence. In simple words, this is what it means. If XRP wants to go 5x or 10x, it won't need a miracle. It just requires the same factors that have historically been shown to trigger exponential price movements. Also, those are not just hypothetical circumstances. These things are taking place before our very eyes. The fuse has been lighted, to rephrase. All we need is anything to trigger the chain reaction, and we'll be ready. Furthermore, past events indicate that it will not be a slow burn once it starts. The majority of markets will be left frantically trying to play catch-up due to the quick and aggressive repricing. Knowing what's coming is crucial for that reason. There will be no time to react once the shock starts if you believe that. The move will have already been initiated by the time you notice the headlines and your friends begin to text you about XRP. These marketplaces function in that way. Preparation, rather than response, is rewarded. Now for the exciting part. There appears to be a chain reaction of shocks in the current configuration rather than simply one. We should expect liquidity to arrive in spurts. After the initial shock, XRP is repriced into the double digits, followed by consolidation, further waves from institutions, and finally, retail FOMO. In a stair-step pattern, the intensity of each shock increases with each passing one. That's why, during this cycle, economists are predicting prices of $20, $30, or even $100 rather than merely $10. Not all at once, but as a series of shocks as the adoption process progresses. It has historical backing, structural support, and mathematical backing. Most investors don't have the self-control to wait for a setup to be obvious or the fortitude to ride out turbulence. Today, we are smack dab in the center of that arrangement. Understanding XRP's behavior in comparison to the majority of the crypto market is made easier when one considers liquidity cycles, institutional adoption, and exchange supply mechanics. No matter how much attention Bitcoin and Ethereum receive, XRP has a distinct advantage in one important respect. As a settlement asset, its design has always been crucial. The value of XRP is directly related to the influx and outflow of wealth in the global financial system, as opposed to most tokens which are driven by speculation or ecosystem development. This is how you should look at it when financial institutions like banks and payment processors include XRP in their settlement stack. They are basically adding structural demand to the market. That demand is constant use, not a passing fad. You can observe how rapidly usage-driven demand can produce severe shocks when you combine that with the fact that the supply of circulating exchange is thin and concentrated. Contrary to speculative cycles, which end when the buzz dies down, XRP is connected to actual liquidity corridors that are only going to grow in size. Why is this cycle different from the others? Let's dissect it now. Within a few short months in 2017, XRP jumped from less than 0.25 to more than $3. The primary motivator wasn't widespread institutional support. It was all about relationships and the potential of XRP. The mere supposition caused one of the biggest percentage changes in cryptocurrency history. Although XRP once again demonstrated strength in 2021, it was hindered by the continuous regulatory disputes. Because of the lack of clarity, investors were wary, and most institutions chose to sit on their hands. Notwithstanding these obstacles, XRP was able to pull off a number of explosive explosions. This cycle, however, has seen a dramatic change in the dynamics. Clear regulations are on the way. Not only have institutions expressed interest, they have also begun construction. The idea of tokenizing physical goods is becoming a reality. Asset managers such as BlackRock and Vanish are actively testing it. Cross-border integration of ISO standardized payment rails is happening. Above all else, crypto markets have been historically boosted by a change in the global liquidity cycle. This is why a large number of experts predict that the supply shocks of this cycle will be far more severe than those of 2017 and 2021. This time, institutional investors are also jumping on the bandwagon. Large financial institutions, banks with actual settlement requirements, and exchange-traded funds are paving the road for widespread adoption in a fashion that complies with regulations. Such massive demand not only triggers rallies, but also completely reframes XRP's valuation model. We can go back to the arithmetic to get some perspective on that. The XRP cryptocurrency is among the most valuable digital assets, with a market worth of $166 billion and a price of $2.78 per coin. However, think about the consequences when the daily volume reaches $50 billion or higher, as it has done previously. Due to the limited quantity of currency, prices could quickly rebound into the $10-15 area. As acceptance increases, institutional momentum could easily drive it up to $20, $30 or even higher. Markets always overshoot when supply shocks occur, notwithstanding skeptics' claims that such figures are overblown. Nobody thought XRP would reach $3 in 2017 until it actually did. Until it happened, no one thought volume could hit $51 billion in November. Such is the character of cycles of exponential growth. They never seem plausible until they're over, and then everyone can see how apparent it was. The psychology of disbelief is another important topic that this brings up. Many investors are writing off XRP at the moment since it hasn't done anything yet. Assets that have previously inflated are being pursued by them, while XRP is covertly laying the groundwork for its next breakout. These configurations function just in that way. It will be well underway by the time retail focus returns to XRP. When that happens, most people will have no choice but to buy at a considerably higher price, which will fuel the surge even more. It's important to remember that leverage makes these shocks even worse. Traders rush to leverage their positions when XRP starts to rise, speeding up the upside. Due to supply constraints, exchanges raise prices, setting in motion a feedback loop. Leverage increases profits, but it also eliminates sloppy traders when market volatility is high. That's why, even during bull markets in the past, most individual investors lost money. During downturn, they panicked and over-leveraged. They also entered the market at the incorrect periods. That's why the people who wait for the move to happen never end up winning. They were the ones that had a head start because they had figured out the layout in advance. Always be well prepared before acting. Moving on from cryptocurrency, let's examine the international financial scene. The flow of money across national boundaries is undergoing a paradigm change that will last a generation. Digital currencies are being tested by central banks. Companies are now tokenizing assets that didn't have much market value. Blockchain technology is being used as the foundation in the rebuilding of payment rails. These changes indicate that blockchain will be more than just another technology in the future. The system is it. A neutral bridge asset should be at the core of that. The ideal one would be quick, inexpensive, and easy to scale. With its extensive testing history, operational corridors, and institutional support, XRP is among the rare assets that meets all of these criteria. This cycle feels different because of that. Discussions regarding the potential uses of XRP are off topic. To grasp how quickly adoption can scale when liquidity floodgates open, one must first be aware of what XRP is doing. Whether or if XRP can move isn't the most important concern for most investors. That it can has been demonstrated throughout history. The important thing is to decide if you will be ready for the next shock before it happens or after it has already begun. The window of opportunity quickly closes as the relocation begins. Another thing to think about is this. There has always been a consolidation phase at far higher levels following each major parabolic cycle in cryptocurrency. The floor is constantly rising, to rephrase. The XRP floor increased from a few cents to tens of cents in 2017. The floor increased from less than $0.30 to more than $1 in 2021. After the following round of shocks, the new floor can be anywhere from $5 to $10. The impact of adoption compounding is that this doesn't merely generate short-lived pumps. It sets new standards from which subsequent cycles can be measured. Just think about the consequences for global institutions when they start to view XRP as infrastructure rather than a speculative asset, when its rails are traversed every day by billions of tokenized assets, when financial institutions use it as a method of routine settlement. Then the $10 to $20 or $30 XRP price tags will disappear. Real-world settlement flows up to trillions of dollars are reflected in these assessments. That isn't publicity. Systemic adoption reaches its logical conclusion at that point. Keep in mind that markets always reflect future prices, and the price of XRP will have been adjusted to reflect this acceptance by the time it becomes completely apparent. This highlights the essential importance of the next 12 to 24 months. They stand for the lag period between when adoption is happening behind the scenes and when the market actually responds. Never in history have the most astute investors been those who sought attention. They were the first to notice major changes in the system and set up shop accordingly. XRP currently stands for that opportunity. Finally, we are on the brink of a supply shock that has never happened before in the history of cryptocurrency. Changes in the global financial landscape, the clarity of regulations, institutional acceptance, and the liquidity cycle are all happening simultaneously. Everything is in its proper mathematical and structural form. And we know from past experience what happens when these factors come together. XRP doesn't merely fluctuate, it erupts.